we were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amos. This podcast is for real estate investors and real estate educators. So if you're investing in real estate or you're providing content, teaching real estate investors, this is the podcast for you. This is a special once a quarter podcast that we're doing, and this is an extra special one because we have our guest here in studio. This isn't really a studio, guys. This is a conference room, but we're calling it a studio today.
It works.
So we have Mike in the house. We're going to go through the market pulse update. We do this once a quarter, and we're going to be focusing in on the Twin Cities. So, Mike, welcome to the show, man.
Well, thank you, Kevin. Appreciate it. This is really cool being here in town. Usually I'm in Minnesota and you're here in Colorado.
Yeah.
But I am here. I'm going to be speaking tonight at the Colorado RIA. So when I was talking about it the other day and you want to do this,
This is perfect. Yeah, Mike's like, we got to do this in person. I'm like, I don't even know how to do that. It's all been Zoom since COVID. So,
yeah.
In fact, we still are on Zoom, but just to record it.
Right. Well, we made it. You made it work. So
Yes.
That's the important thing. Well, there's a will, there's a way.
Well, let's get into some statistics and some market information here in Minnesota. I know there's a lot of fear out there. There's a lot going on at macro level. Which is good. Maybe, I mean, good news, bad news. This is the common thing, Mike, that I'm seeing constantly. Like, good news sometimes is bad news. So you have a good jobs report, let's say, and then the stock market reacts negatively. And the reason for that is because of the concern that the Fed won't cut. Then now it's more normal. You get a bad jobs report, like the recent one,
right,
and the stock market takes a dump. So now we're back to bad news is bad news. So good news, bad news. I mean, what are we looking at here more on a macro level?
Well, it doesn't matter, good news or bad news. You just need to know what the news is. As long as you know where things are going, as far as real estate goes, that doesn't really matter unless everything is crashing like it did, like 15, 16 years ago.
Yeah.
That's a little bit of an anomaly because the markets are always up. They always have ups and downs. And you can make money in real estate, whether it's an up or a down. It's just what's your strategy and change your strategy and your philosophy and everything else depending on what's going on in the market. And then sometimes you're going to have slower times. Sometimes you're going to have, where everything's happening real quick. Like you and I were just talking about that yesterday. I'm in the last year, for the last probably 3-4 months, I haven't bought anything.
Yeah. Yeah. You did mention.
I've made a couple offers, but nothing has come through. But the 12 months prior to that, I was buying at least one a month. So I was closing on about one a month for about a year. But then I had probably about a 6 or 8 month period before that where I didn't buy anything again. So it's feast or famine with real estate.
And all of what you're doing is in Minnesota.
Correct. I'm 100% in Minnesota right now. I used to invest in different locations, and I have lived in a few different spots around the country. Actually, even in Canada. So So
Minnesota, Canada, it's kind of the same thing.
Well, it was, but it's still a far drive. I was in Toronto for part-time I spent half of the year in Toronto for about 13 years.
I didn't know that.
Yeah. So I was invested in Toronto. I've invested in New York, Chicago, Wisconsin, Minnesota, and I've done a couple in Iowa.
Cool.
So the thing I learned though is, for me personally, I'd rather have everything that's close and with like about an hour or so drive with me. So I do have stuff all over in Minnesota, like the Twin Cities. I have stuff out west up through St. Cloud. I have stuff up in Duluth. But I'm an hour and a half drive from pretty much everything.
Yeah.
I have when I had other properties in other locations, even though I was there, and then when I moved back to Minnesota permanently, those became my problem properties because I wasn't able to deal with them in a timely manner.
It's funny you say that. Share a quick story with you. I have a property. I'm just starting to keep some of the properties we foreclosed on in Minnesota, and so there's a duplex in North Minneapolis, which we all know. North Minneapolis, a little tougher area to own property in, but we just moved a tenant in. We have a property manager. We just moved a tenant in without screening the tenant, and without making sure that they're on the Section 8 that they said they were on. There's no voucher, there's no documentation. So now we have a squatter. So in over 20 years of being a real estate investor, Mike, I've never seen anything like this. Well, now I own property and it's hard to manage. from outside my backyard.
Yes, it is. Which is why it's very important to get your tenant screened. In fact, and you're talking North Minneapolis. I mean, I don't know exactly where your property is, but I just sold one well, I sold it on a contract in North Minneapolis. And it was a great property for me for many years. Always had Section 8 tenants in there. But the crime has been getting closer and closer to where that property was. It's in North Minneapolis. And beforehand, people would, if I told them where it was, they'd be like, oh, voodoo. I'm like, no, this little pocket here was good, but because we didn't have any crime, there was hardly anything going on there, but the crime was around the area. Well, now it's gotten closer, and now the tenants don't want to be there. The good tenants, the ones that we would qualify, we turned down, I want to say 17 or 18 tenants in a row on this particular property this spring. And we finally like, we're done with this property. Well, I sold it on a contract for deed. Got it.
It was a single family.
Single family.
Yeah, okay.
They were renting a property 1 block away, and they want to stay in the area. And they know the area, they're comfortable with the area. And so we sold it to them on a contract for deed.
Got it.
So now it's cash flow. I love it.
Yeah, I don't know what I'm gonna do. No, I have another 3-plex that it's brand new. We just built it. So we're gonna
talk to me. I'll take a look at it, and I might even buy it. We'll see.
we might have to do that offline here. I think I need to keep it for a couple of years to not lose on it though, but we'll see.
Okay.
All right, so we have the inflation numbers came out about maybe a week ago, the CPI numbers, and they came in lower and right in line with what the expectations were. So we had bad jobs numbers, and now we have inflation definitely coming down. It's on track, it's hitting expectations. So overwhelming odds of a cut in September. And I believe that is already built into the markets.
Oh, that's definitely built on the markets. And we haven't talked about this yet, but I do expect a cut. But only for political reasons, not for any financial.
Oh, really?
Well, if you listen to even to the Fed, I can never remember the guy's name, and he's in my backyard. The Fed chair of the Minneapolis.
I don't know.
It's like an Indian Middle Eastern name. I can never remember it off the top of my head. But he was saying even just a month or two ago, he's like, I don't see any reason for us to adjust the rates up or down when everything is where we expect it to be. So why would we mess with it? But the markets have got it all built in for a price or a cut, and by evidence of the fact that the mortgage rates came down a couple weeks ago.
That was because of the jobs report.
No, that was because the market already predicted and they built in. So the bond market and everything is already built in a cut in September. And this has happened.
The 10-year dropped like over half a point.
Yeah, but they don't follow the 10-year anymore. The bond market is betting what they're gonna do. So it's the bond markets and a few other markets like that. And I've struggled trying to understand this stuff for a long time too. But talking to everyone that I know that follows this stuff and they're like somewhat experts, not the experts, but they're really well versed in this. I've been learning from them, and they're all telling me the exact same thing. And I started paying attention to it a couple of years, and damn if it ain't right. Every single time. The bond markets and everything, they're betting that what the Fed's going to do. And if the Fed does what they planned on them doing, nothing changes.
That's right.
And if it doesn't happen, then everything.
So it's interesting you're bringing this up, because in the newsletter this month for the listeners and viewers of this amazing podcast show, I am doing a article on interest rates and why I don't believe the mortgage rates will go down when the cut happens in September, like we assume it will. You might actually see mortgage rates go up. And it's because of what you're talking about, because of the bond market. But here's why it's tied to the 10-year. From what I understand, the 10-year is the long-term fixed rate, risk-free rate. So if you hear risk-free rate, long-term income, the gold standard is the 10-year treasury. Okay, so if I can invest for a long-term fixed rate into a risk-free, whatever that rate is, what's the amount I need to add to that to take on a little bit of risk? So whatever the risk is perceived in the mortgage bond market, that's going to be what we call a spread. So you have your 10-year fixed rate plus your spread, whatever it takes to entice investors into the bond market. And that's how they price mortgages.
Well, so my understanding is it loosely follows it. It doesn't exactly follow it.
Well, no, because the spread moves.
Okay.
Right. So if you look at like a 50-year average risk spread on mortgages,
Okay.
it's about 1.7%.
Okay.
We're floating around 2.5% right now. And there's a couple of reasons for that. One, well, there's just perceived risk, but one of them is refinance risk. So the lenders need to make as much money as they can now because those loans will start refinancing when rates come down. So they're trying to capture money quickly now.
Mhm.
Okay, but then they're also worried about a potential looming recession, right? If housing goes into a recession, that adds risk. So that's why you see the spread increase.
Right, and that's why my understanding is it follows a 10-year, but loosely because you got those other
Yeah,
variables, like
exactly.
you're just talking about.
Yeah, exactly.
In fact, you're talking about the refinance rates. I just pulled up a video. I don't know if you can share it or not.
Oh, maybe.
Talking about refinances and stuff, because the three refinances went up 35% week over week last week, and 100 and if I remember it, 100, little over 100% year over year increase on refinances just last week.
Wow.
I
Let
got
me see if I can get my
that-
mind around that. So 100% increase on refinances from this time last
from
year.
this time last
Okay,
year,
okay.
and a 35% from a week prior. So they're talking. I think they're talking about last week, and then what they're comparing to is the week prior to that.
Okay. So a week and a half ago or so, when that jobs report came out and the 10-year tanked, stock market tanked as well.
Oh yeah,
But the markets have recovered from that, and interest rates have come back.
Now
up.
they recovered. They went up.
Yeah, yeah. The stock market's higher now.
Yes.
yes, yeah. That's right. Okay. Cool. Anything on macro level you want to chat through? Get into some of the Minnesota stuff.
Well, the Minnesota on the macro level, the Minnesota stuff same as national, and the big issue is just lack of inventory. Inventory, and I mean, there's a few markets that I've been talking to people about where their inventory is on the high side because some of the builders have started to build in those areas. But I mean, I've been going all over the country speaking, and I'm not running to not any of the ones that I spoke at this year are seeing a decrease in values or overabundance of inventory. Everywhere I'm going, I'm seeing a lack of inventory.
Yep.
I mean, we're here in Denver, and I was driving around a little bit yesterday afternoon, and then this afternoon before I came over here, driving around a little bit, looking at the area. I'm not finding any for sale signs.
Yeah.
They're just not there.
Yeah. And days of market have increased in Denver as they have in Minneapolis. I know you're
And I think
that.
everywhere, everywhere else too.
But the months of inventory, which you and I think agree is one of the best indicators because it's supply and demand. It takes them both.
Right.
And for the first time in a while, Minneapolis is lower than Denver. We track both Denver and Minneapolis closely because that's where our two primary markets. And Minneapolis is pretty strong. It's probably pretty tough to be a real estate investor in Minneapolis right now.
Well, tough from the standpoint of being able to find deals.
Right, exactly.
Great from the standpoint of once you got the inventory, there's a never ending supply of buyers and tenants, unless you don't screen them properly.
I have tenants you could have. Okay, well let's look at some of this stuff. You said you had a few slides, I think.
So this is what I share monthly with our members. I just updated it this afternoon because the July numbers just finally came out. They weren't out last week, but they just came out now. So it takes a few weeks for the numbers to come out. We had a 35% increase in mortgage refinances week over week, and then 118% year over year. And that's what they were hoping for. Because I remember even a week before that, I was listening to, I don't know if it was the same one or somebody else I was listening to, that they expected the refinances to come up because the rates had dropped under 7%. They got down to like 6.6 or whatever.
It dropped to over 0.5%. Like that.
Yeah, in a week. And that was a few weeks ago.
Yeah, and they popped back up.
Well, they haven't gone back.
There was only like 36 hours where and then it went back up again.
No, it's still down there. It's still down to 6.5, but it got down to like 6.4 about 2 weeks ago, I think.
Yeah,
And
yeah,
because
exactly.
it was before I got on the road. I remember that. And they were all predicting that they were going to have the refinance boom that week. And then I listened to somebody else last week on a podcast talking about it because I was traveling, so I just listened to podcasts. And they were talking about it and so I was listening on YouTube podcast. And like the refinances are not coming yet. And these are mortgage guys who are talking. And then this week, a week later, now they're saying, okay, it hit. It just took people a little while to wait for it. Because I think the other thing that people are waiting for too is people are still hoping that the rates are down lower, especially now that they hear that well, the Fed's gonna cut, and we've been talking about cuts all year long. And you and I have had this conversation a few times.
Yeah.
That they may be cutting sometime, but we don't see it coming anytime soon because the indicators were not there. But everything now is leading up to the fact that they're gonna cut. The Jerome Powell's came out and said that they're gonna cut. Most of the time, Eddie's came out and said we would cut if. This time it was more of a well, we're gonna looks like we're gonna cut unless something else changes. So the way he phrased it was a little bit different, gave the markets a little bit more confidence.
And I think we'll drop this next week, Mike. And what we're missing here is the Friday news from Jackson's Hole. So we don't know. I mean, we're going to get some really clear indication.
And I was just there 2 days ago. I should have 3 days ago. I should have just stayed there.
But yeah, I think we agree the cuts are coming. I think we both agree. And this is something that confuses people. That doesn't necessarily mean mortgage rates are going down.
Right, because the markets have already bet on what the Fed's going to do.
Yep.
So they're pre-priming, and it only changes if the Fed doesn't do what the markets were expecting.
And what I have seen, because I've tracked this, the short-term rate or the overnight rate, which is what the Fed actually cuts. It's what the rate that they cut or adjust is the rate banks borrow money at.
Correct.
So it doesn't they don't set mortgage rates. But what I have seen is it's a pretty good leading indicator for mortgage rates. So it's not a perfect correlation. I mean, it doesn't correlate necessarily immediately, but over time, as they cut, mortgage rates come down as well.
Yeah. Well, it used to, when they would cut, there'd be about a 4 to 6 month lag and rates would come down.
Yes.
Now things have actually flipped because of technology and everything else right now. Now the markets are predicting what's going to happen. So the mortgage rates move before the Fed does anything. And I've been tracking this for the last couple of years. And if every time that the Fed has done what the markets have predicted, there's been no change.
Yeah, no, that is true. I 100%.
The next change comes when they right before they predict the Fed to go up or down again.
Yeah, so that's the risk-based pricing that we were talking about. But if you look at profitability of banks and lenders, if the rates go down, they have more room, they have more flexibility to lower rates if they want to.
Well, yeah.
So that's why I say it's a leading indicator.
Right.
But yeah, again, there's no guarantees of anything.
Absolutely not. There's no guarantee there's going to be a cut this week. There's no guarantee there's going to be an increase.
Right.
There's no guarantee it's going to stay flat. We have no idea. Everyone just predicting. And we have seen the markets predict all year long and been wrong every single time. So we don't.
And so
just speculation on our part right now.
So in the Twin Cities, we're continuing to see price growth. Right?
Yes.
It just continues to go up. Despite all the negativity around real estate and interest rates. And so I think the markets overall is sort of adapted to the 6.5% to 7% interest rates.
I think they have.
So is now the time to buy?
Depends on what your situation is. If you're planning on this is what I tell most people. This is what I tell most people who are not investors. It's like, oh, should I wait or not? Because they're always asking for advice. And my advice to them is if you're gonna plan on living there for at least the next 5 years, then it doesn't matter what the rates do. You're there to live, and you're gonna either pay the rent or you're gonna own. Now, if you buy now, think about with inflation and everything else going up over time. If you're gonna be there for a long time, you're still gonna be making money because later on, like 5 or 10 years down the road, when you're making that mortgage payment, you're making that payment with cheaper money.
Yeah. So you just refinance.
It helps you.
Think about this. If we go to the very basics of economics and home values, it's all supply and demand.
Correct.
So if you're waiting for, I'm talking to the listener here, if you're waiting for rates to come down to go out and buy an investment property or a primary residence or whatever it is, think about what lower rates does to demand. And if I'm accurate when I say it will increase demand.
Oh, heck. Rates go down, yes.
Higher demand with similar supply creates price pressure. Okay, so that means the prices could go up. So are you waiting for rates to go down because of an affordability issue, and then all of a sudden real estate values pop and you missed it? That would be a concern.
Right. Yeah. And if you are just looking for the quick flip, okay, well, just buy it right. Doesn't matter what the rates are going to do.
Yeah, it doesn't. I mean, if you're flipping, you're buying and selling pretty much in the same market.
Right.
As soon as you're doing it right. If you hold it for 2 years, then that's different. But if you're in and out and you're rehabbing 2 months, 3 months, and it's pretty similar market condition, I would think.
Yeah. So you just have to look at what are the current conditions right now, and what's your long-term plan with the property or short term. If it's a flip, who cares what the rates are? Because the buyer, especially right now, even if rates go up, the buyers are still buying.
Yeah.
You might have to hold on to the property for another 2, 3 months. That's what's happened to a lot of the rehabbers that have been rehabbing over the last couple of years. Is every time the rates have gone up, they've had to hold on to it for a couple more months, so their holding cost goes up a little bit, but they still get the property sold.
Yeah.
And they're not holding on to them and having to turn them on into rental properties like we had to do 15 years ago. We bought a property, 15, almost 20 years ago before the last market crash. And this is actually might be an indicator when the market crash might come, is if we have a couple of years where you plan on the price of reselling it, but prices come down and interest rates go up a little bit and you have to turn around and rent it. So if you see people get into that situation, okay, now that's time to start thinking,
That's interesting.
is there a change coming? And that's exactly what happened to us. I want to say in like 2006 and 7, before the market crash in white. Those are the situations.
Yeah,
we're
I remember
in.
that. So I do get questions a lot, Mike, about the market crash in 2018 or 2008, and are we facing a similar environment? I think we both agree no.
No.
But I did write a report, a pretty extensive report comparing the 1990 crash
Okay.
to what we're going through today. So for the listener, thepinereport.com, it's thepinereport.com. You can get it for free. But there's a lot of, not a lot, because every recession is different, but there's more similarities to the 90s crash, because what happened is you're coming out of the 80s when you had hyperinflation, really high interest rates.
We had a couple things going on in the 80s.
So you had the oil bust, you had the war, the crazy government spending.
You
But
have
the
the high-
government spending was similar then to what we went through in COVID.
Oh
It
yeah,
just was funding
I-
a war
I
instead of
believe it.
funding a pan. But
But the economy was totally different at that time as well, because the 80s inflation came out of the taking us off the gold standard and then introducing the petrodollar in the 70s, which is what caused the hyperinflation.
well, that's because you could print money. The whole reason to come off.
Taking them off the gold
Yeah.
standard was, so that was the first time in our history we could print money without having to back it by gold.
And they did that to fight the war.
Yes.
That's exactly what.
And that's what caused that hyperinflation that carried into the 80s, which then that forced the Reagan administration at that time to put in one of the most dramatic tax overhaul in world history. And what the major thing that they did was they eliminated a lot of the deductions that real estate investors were, because they were buying the properties back then. Didn't matter how much they were paying for them because they were writing it all off. So they would take a negative cash flow, but they were still making money on their deductions. And that's what they took away. And that killed real estate for about 5 years. And then it was on the way to recovery, and then the 90s hit.
Yeah,
And then a whole nother issue.
that's just coming out of the savings and loans crisis and all of that. So, it's for that. If you're interested in trying to compare a recession to what we may be going through today, it's thepinereport.com. All right, let's get into some of the stats here, Mike. What are we looking at?
So median price, it's year over year, it's up about 3%. It's at 389, but that's down from the previous month. So in June, we hit our peak of 390, and that's typical. June is usually June, sometimes July is our peak. So from a seasonality standpoint,
Yeah.
right. So we're always going to hit our peak in either late June or early July. So this year it looks like we hit the peak in June, and it went to 390. So July came down to 385 on a month over month basis, but we're still up almost 3%, so 2.7 year over year. So that's still trending upward. Yeah, that's really strong. Right. So our new listings, that actually that helps. That came up 7%, but that's still not helping enough. But it did come up 7.2%, and that came up to 6,317 new listings for the month of July. Right. And then year over year, we are trending upwards. So if you guys are looking at the screen there, you got the two different charts. You have the blue one, and then you have the gray one on the right. So the blue one is the year, the month to month comparison of a year over year. And the gray one, that's taken, so we're in July numbers here. It's taken January 1st through July 30th. and then comparing that to the same time frame last year. So we're up 10.3% for the year-over-year comparison. So if you just look at a month by month snapshot, that's wonderful, and that's how retail sales and everyone projects everything. But if we're looking at the overall health of the economy, we need to look at a broader time span. And so we're looking at here, it's showing us a full year or 6 months, 7 months worth, January through July comparison of that exact same time frame for the year. That's up 10%. So both numbers are up. That's a good sign for the real estate market itself. Pending sales is down a little bit though. This has more to do with the interest rates, and this is where the interest rates were up there in the first part of July. I would say late June, first part of July. The interest rates are still up in the sevens, and it didn't start coming down until mid-July, maybe towards the end of July. I don't remember exactly when we had that
But they were
big drop.
bouncing around. The big drop was when that unemployment report came up, but that was this month, so that was early August.
Okay, so then
So I think July was kind of just bouncing around 7. Now it would come down, and it was just bouncing right around the 7%.
okay, and that would probably explain why our pending number. Now, based on that, that means our overall inventory should be going up, and it looks like it has been. Closed sales came in pretty flat at 1.2 month, that same month from the previous year, and again, year over year is only up 2.8%. But that's because there's a little bit more inventory and there is some stability in the markets. Our days on market came in at 36, so that is from an annual standpoint, it's up 24%. But from a month-to-month standpoint, it only went up 1. But it did come down a little bit from earlier this year. Earlier this year, we were at just look at really need to read that 59 in February days on market. So in February, in the winter months, we were at 2 months, and then it came down to 1 month, and so we're slowly starting to tickle back up. And guess that's normal.
Yeah, and 1 month of marketing time. I look at days of market. That's what you should budget for your marketing time.
Mhm.
I mean, if you price it right and you do things right, it should be less. But I mean, if that's not abnormal. I mean, a month is not a lot.
No, that's historically that's low.
It's low.
And we wouldn't if now people are I'm getting investors calling me up going, oh my God, I don't know what I'm gonna do. My house hasn't sold.
Yeah.
I'm like, well, how long has it been on the market?
2 weeks.
18 days.
Yeah.
I'm like, what?
Yeah, just
Call me when it gets to 90 days.
Yeah, and if it goes in 90 days, that's not a market problem. That's a you problem.
Yes. Well, well, it could be a couple different things.
Price fix everything.
Well, price fixes everything to a point. From an investor, that's something I learned early on. People always say, yeah, price fixes everything. But I have seen just by making some changes to how you market a
Sure.
property,
Fair.
or where you're marketing it to get the price you're asking. So it's not always just price. Now, if you've tried everything else, then price might be the situation.
So we have another property out in Minnesota. It's really close to Lake Minnetonka, and we're rehabbing it right now. And it was very customized. So this is something that will bring a value down. So the person that lived there was very tall. So the cabinets and everything were built basically on platforms. So everything's really so you and I go in there, we can't reach the damn glass. We can't get our. So something like that, price will fix that. But it's far better to do a correct rehab and make it more standard. Or
I'd have to take a look at the property to make that determination.
we already ripped it all out. We're doing all the cabinets because we can't.
Yeah, see, it might be cheaper to tear that all out and put new cabinets than just the price.
That's right. That's what I'm saying. Yeah,
So there again, price would not fix that.
that's right. That's why I was agreeing with you.
Okay. Yeah, because that one there, you have to fix it so that the masses.
And we thought about like building raising the kitchen floor and like all
No,
these
'cause
different ideas.
That's an example.
Those are
What's
beautiful cabinets.
That's an example of what's called functionally obsolete.
That's right.
It's a functional obsolescence. Those are little things that you got to look at, and you can either fix them by changing it or lowering your price. Now, there's certain things that are functional obsolete that you cannot change, like maybe the entire layout of the property.
Yeah.
If and I have seen that where you have to go through a kitchen to get to a bedroom and a bathroom.
Yeah.
Okay, well, that's a function. It can be fixed,
It's tough.
But that one's very difficult. So your best solution now is just lower the prices. Or maybe if you got a liquor store right next door to your place. That's a functional obsolescence that you cannot fix with anything other than price. And so when I'm looking at those things, I'm looking at, okay, if I'm looking at a property and getting a good deal on it, I still need to look at, okay, are there factors that could create a functional obsolescence? And if there is, that's going to lower the value of the property.
Yeah, and the tricky thing about that, Mike, and where people need to be very careful is you don't know how it's going to impact the value. There's no way to know what that liquor store will do to the value of the property until you actually are trying to sell it.
Correct, because I mean, I've actually seen people say that it's worth more because now it's right next to where my I don't have to drive, I don't have to Uber. So for me, it's worth more. Okay, those are usually tenants, not buyers. At least for me. All right, let's move on and see what we got. Percentage of list price, it's been staying pretty steady, right around 100 for about a year. There was a drop down a little bit last year. That was for a couple months. It dropped down to 90, 97, 96, 97. And 97 is the historical norm.
Sounds normal to me.
So I got down to
I don't put a lot of weight on this because people are, I mean,
Well, what I look at for percentage of original list price, I think has to do more with the way the market's going, and I don't want to necessarily say the seller's greed, maybe more so the listing agent's greed.
yeah,
Because so the closer that number is to 100, that means you're listing it at the right price.
Yeah.
You're pricing it right. When that number goes down, that means most people are overpricing it. So the realtors are not having that honest conversation with the sellers, or they're saying, all right, we'll just throw it out there. I don't think it's going to sell for that, Mr. and Mrs. Seller, but we'll just put it out there and see what happens, and then we'll lower the price after if it doesn't.
Yeah.
And that's where now that's called buying listings. Right. And now if the number's above 100, that means they're saying, okay, we think it's going to sell for this, but we're not sure. And then you get multiple offers, and then the multiple offers bring it up. So that is an indicator to me as to how greedy the market's getting.
yeah, okay, I can see that. And it's sort of forward looking, like you may be able to pick up on a trend to looking at this. You make a good point.
Month supply of inventory. This is the one
This
we
is
were
what I
talking about. Yeah, this is the one that I really like because it's coming at 2.5 months. This is the number we want to see go up. And we've been down under 2 months for over a year. Actually, we've been under, we did bounce up above it for a while, but we've been under like 2 months for on and off for probably the last 3-4 years. With a couple blips when the rates went up, then that time on market did get up closer to 3 for a little while, but then it came back down, got under 2 for a while. So it's pretty low, but historical norm, what you're looking for, in my opinion, is a month supply of inventory somewhere between 4 and 6 months.
Yeah, no, I agree. I would even narrow that to between 4 and 5 is very neutral. You start getting close to 6, I think it becomes a buyer's market. And
Well, yes,
that's
correct.
when you'll start seeing some value, some declining values.
Yes.
So I was just going to ask you, where do you think, like, if we're worried about the market, we're worried about the housing crash. We see some YouTube videos telling us that we're running into a storm here. And this is a matrix you like. What number would indicate to you that we're in some trouble?
For the month supply?
Yeah.
Not the number so much as the percentage of change of the number.
Oh, that's good. I like that.
Because I don't care if we're at 9 months. But if we've been hanging around 8 or 9 months for the last 6 months, okay, now I know it's stable. So I know what numbers I'm working. If I start seeing a dramatic change, it goes from 2.5 to 3.5 in a month. That's a dramatic change.
I see. Yeah, that makes a lot of sense.
So I'm more concerned about the percentage of change than I am.
Is there a percent of change that would scare you? Or throw up some caution?
I don't know what that number would be. That's going to be a case by case.
Yeah, that's a tough question for you.
I
agree.
don't know how I would answer that one. I mean, if you look at this graph down here on the bottom of the screen, you can see some straight ups and straight downs. Those straight ups, those would concern me. Like we had back in 9, 10, 11. And it was really hard to see.
Yeah, so
on
this
the
goes
screen.
from 2004. And if you're just kind of looking, I mean, this is an eyeball test here, but you're looking at like an average since 2004. It does look like it's right around 4 months, maybe 4.5. Yeah, somewhere between 4 and 5. It kind of looks like that's pretty average.
Yeah, and then when the market crashed in 08 through about 2010, 11, It was up there in the double
Yeah,
digits.
went over 10. Yeah.
Right. But it was the the speed of the change is what concerns me. Because I made some as an investor, when the days on market were at 12 grand, I made more money or 12 months. I was made way more money as an investor back then than I can make now.
Totally.
But that's because I knew what we were in and I was watching the numbers and I wasn't seeing the dramatic changes. And that's when I started buying again, is when I saw in 2010, we started seeing the speed of the change slow down. So the declines. And when I saw that speed slow down, that's when we started buying again. It was in 2010. And then in 11 and 12, it really took off on us.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. I remember the 2010. I bought a lot of houses that year.
I didn't in 10, but I started buying in 10. But in 10, I was still, the first half of 10, I was still trying to liquidate my inventory from 08.
You're still trying to, yeah.
I had so much inventory at that time. It took me 4 years to clear it all out.
Yeah.
But I had gotten through most of it in 2009 and early 2010. And then the rest of it took me, I got down to about 10. That took me another 2 years to clear out. Because I still had tenants and some of them that were paying, but then they would move out and then I couldn't re-rent them for what I owed on them. So it got nasty at that time. But when we started rebuying for flipping, it was late 2010 and we really ramped it up in 11. And then in 12, the market changed and started going up.
Yeah. That was a good time. We're not seeing that now, so
no, we're not.
Don't get your hopes up on that, and don't get your hopes up on 3% interest rates again.
Right.
Unless we get another pandemic.
Correct. Inventory of homes for sale coming in 11.4% increase year over year at 9,300. Now I remember back in the day when we used to maintain in the 20,000s. So we're still half of where we used to be, which, and if we can get back up there, that's when we start getting up in the mid to upper teens inventory. That's where we're going to start seeing prices come down, or we should start seeing.
Yeah, and yes, I agree. Except the missing piece is demand. As inventory rises, is demand keeping pace? Because if they keep pace, you're not going to see a decrease in value. Everything will be status quo. It's if demand drops and supply goes up that you would see that.
Well, yeah, and what I'm saying is I'm thinking demand will keep up with the increase in inventory up until it gets to the mid-teens.
Oh, you think the demand will slow?
If you get up to the mid-teens, that means we're getting enough inventory to keep up with the demand. Because our historical numbers in the Twin Cities, and we're talking, I've been doing this for 30 years, has been in that 20 to 25 range.
Okay.
That's been our historical norm. And that's where it's always been a comfortable number. Now, we also had about a 20-year period where we had no population growth. It was like flat, like 15 to 20 years. But over this last 10 years, our population has gone up.
Yeah.
And I even hear a lot of YouTubers saying, oh man, Minnesota is one of the places where people are leaving from Minnesota in droves. Well, yes, they have been, but we've also gotten a lot of come into Minnesota. Well, so that number has actually still gone up.
The jobs. I don't know if we get into that here. We're probably not going to get into that here, but I know the unemployment rate's really low.
Really low.
There's a tremendous employment there. So that brings people in.
Yes. And the welfare. And welfare. And we have a pretty robust welfare system. People are coming from all over for that. Housing affordability index. This is a big one to keep an eye on. We're at 116, which is down a little bit from year over year. And for me, I want to see the housing affordability index above 120. Actually, I want to see it in that 130 or above. That 120 to 130 range is where, and this is probably one of the biggest indicators for me. That 120 to 130 is where I feel like there's financial stress for people. You get above that 130 and they're not that stressed on average. You get under 120 and that's major stress.
Okay. And so we're at major stress, and this accounts
Yes.
for, does this account for rising insurance costs, I assume?
The housing affordability index
Everything.
is everything combined. I don't know how they run the numbers or where they're getting the numbers from, but I've been tracking this ever since the crash in '08. Because the lowest the number got to in 2006, before at the peak of the market, the housing affordability index got down to 118, which is higher than what it is now.
Yeah, see that.
The difference back then is we had, you know, quadruple the inventory
Yeah.
than we have right now, available inventory. And I don't foresee our inventory struggles changing dramatically anytime soon.
Well, inventory, I remember, I don't need to go into it. I was gonna say, I remember being a little tight right before the crash, but
In '08,
yeah, in 2006 and 7, the inventory was rather tight, and then all the
Mhm.
inventory came through the foreclosures. That's what loaded up the inventory.
no, the inventory was actually oversupplied at that time, and at least in my market.
Was it?
Yeah, we were literally. It was so bad that the builders were sitting on so much vacant property. And it started a year before when the economy was fine, but by the time they got them finished, there was, you look at these developments that they were building, and 3/4 of them were empty. And so we were leasing the properties from the builders with the option to buy
Back before the crash.
before the crash. So like in '06 through '08, I probably did about 7 or 8 of them from the builders. And one of my friends, I think he did over 20, where he negotiated a lease with the option to buy.
Yeah.
And that means the builder, they were going to refinance they're personally refinancing their construction loans and refining them into long-term so that they could lease them to us. And we're getting 3-year lease options out. Well, 1-year renewables, the creative way. So
So
we
the
weren't.
great time you're doing lease options because
Yeah.
the crash hit. You're like, all right.
Absolutely. This is an interesting one to keep an eye on, and this tells us where the financing's coming from. So the top line, that dark blue one, that's conventional financing. So 71% of all the traditional loans right now, retail prices are coming in with traditional financing, conventional. The next highest one is at 16.5%. That's cash. That's how much cash is still out there in the system.
It's very interesting, isn't it?
Yeah, and they're getting this from the CRV values and stuff from the closings. So there's double the number of cash transactions, over double, compared to FHA and VA loans.
Do you think that's a product of the interest rates? Even though interest rates are still historically low, they are higher than they've been in the last 20 years.
I think it has more to do with, I don't think the interest rates so much as
There's a lot of money out
the
there.
affordability, the affordability, because FHA and VA are like I know a lot of vets that when they go to talk to the lender and ask for a VA loan, they run their numbers and they're like, yeah, you can qualify for it, but it's going to be cheaper for you in the long run to go conventional.
Yeah. That's
Because you qualify for and it's only 5% down as opposed to 3.5 for FHA or 0 for vets.
right.
It's still cheaper to put that 5% down and get a convention.
Yeah.
And it's easier. I don't know about the qualifying. I'm not a mortgage guy, but I do believe it's still easier to qualify for conventional right now than some of those terms.
Yeah, I mean, VA is they got 0 down payment and a really low default rate.
Mhm.
And the reason for that is because their debt service coverage ratio is so low.
Yeah.
So they're hyper focused, like banks are right now, on cash flow and
Right.
less about down payments.
This is one I've been starting to track lately. This is Showing Time, and Showing Time is the company that the MLS is. I don't know if it's all over the country, but this is the one in Minneapolis, anyways, in Minnesota, where when the realtor is going to schedule an appointment to show a property, the Showing Time is the company they use to do that. And so they're tracking to see what was the listing price of the property that the realtors were showing at the time of the showing. So this one is the only one of all those charts that we've been watching that was a leading indicator. The rest of them were all lagging indicators, meaning that had already happened. By the time we saw the numbers, that's what happened. This is telling us what the buyers are looking for.
And I'm just thinking out loud here. We haven't been doing a good job of this, but so a lot of the people that consume this podcast can't see this because they're in their car right now. So let's talk through like what are we looking at?
So the showing time numbers come in at 331,997, which is basically flat from the exact same time year over year, which is about makes sense because that's pretty much flat from where the median price for the year ago as well, or maybe up a little bit, but it's still flat. But what this tells me is what price range is the average buyer looking at? So when they're going, because when they're going to go to the lenders and say, how much do I qualify for? The lender's going to say, okay, you qualify for 300. Well, when they tell the realtor and the realtor's going to start showing properties, they typically bump that up a little bit, like maybe 10%, and in hopes that
Negotiate.
that they can negotiate or find a property that has, needs a little bit of work and that somebody else, but they're still going to try to show them a little bit higher, knowing that they can qualify for up to, plus the fact that if they're going to put down 5%, well, they're still going to be a little bit above that. So that's telling me the price range that the buyers are looking at right now. So that's what they can afford.
Mhm.
And this is another one that I'm more concerned about the percent of change.
I can see that. Yeah. I like how you describe that as a leading indicator.
Right. Because then I get to know, okay, if I'm looking at comps, so I run my comps on the property, I'm looking as an investor, and I go look at my comps, and my comps are coming in at 300. And I see that the showing time has been staying pretty flat for the last, several months. Like, okay, then I'm confident that this number is going to work in a couple months from now. Because these buyers that are looking right now, they're not going to be, they might not be closing on a property for another 2 months anyways. Well, that might be when I get my property ready to sell.
Yeah.
So now I know at what price range they're being qualified at. But if that starts going down, and I'm looking at a property at 300, that's got an ARV of 300, and that's going down, I might want to reevaluate my numbers and say, okay, yeah, it's coming in at 300 right now, but I see it going down. I might want to adjust that and maybe make my offer based on 280 because it's trending downwards. By the time I get the property ready to sell, the property might only be worth 280. So for me to maximize my return, I want to start looking at that.
I think this is really good and something I think a lot of even experienced investors will miss.
Yes.
Because everything, when you comp a property, you value a property, it's all historic data. So this is forward looking. So this is just another data point to help you evaluate.
Right. Yeah. And if you're flipping houses, these are the things that you need to be looking at.
Right.
Because you're not buying the property today and then selling it today. I mean, think about the comps you looked at. The comps you were running were what sold 2 months ago. And this is one, so this is actually this very timing that we're talking about right now. This is the time of year that most investors screw up. Because we're on our comps, what are we looking at? We're looking backwards for the last 3 to 6 months, right?
In the peak season.
Right. So our comps are coming up in June and July, the peak, and it's coming in at 390. And we're going to buy a property with a 3-month hold on it, and we're going to put the property back on the market in we're at August right now into September. We're going to be putting the property on the market in November, December. Okay, well, the prices by then have already dropped.
Yeah.
In order to maintain your profit, you're going to have to hold on to the property again until March.
Yeah.
So
This is good, really good information. I think I need to add this to my valuation presentation that I occasionally give to your group, because I think this is something that's very easily missed.
right.
Yeah, especially right now. You are so right.
Yes. And it also works to your advantage when you're buying in March and April because accounts are running against we're in January and December, which we're at the lower part. So you can actually bump your numbers up to be competitive early in the year because and if you follow the seasonality of these numbers, June and July is where the peaks. December and January is the valleys.
Yeah.
Right. So you just need to know which market you need to understand which market you're going to be reselling in. Now, if you're buying to hold, this stuff doesn't matter. If you're buying to hold, right? Now it's a totally different strategy and will cash flow. Now you have to run your analysis based on the cash flow.
Yeah. So not only what market you're going to be selling or time you're going to be selling in, but what time is the comps in. So you're right.
And that's one thing people miss all the time is they're looking at the wrong comps based on when they're going to be selling the property.
Yeah. All right, I have a topic I want to address with you, but are there any more slides you want to go through about?
No, I think that was
it.
That was about it.
Let's get this back so they can see our faces for those of you that are watching. So I get, Mike, I've been getting the last couple of days people asking me about inventory, and estimates are 4.5 million short based on the slope building that we've seen
You're talking about nationally?
nationally.
Okay.
Yeah. Kamala Harris has just announced her.
You're gonna ask.
So I don't want to get political, but
Mhm.
I'm just curious what your thoughts are on this. So she just announced a housing affordability plan at the Democratic convention. And there's some interesting pieces to it, like some tax incentives and things to help. And then some free money again. She wants to give away free money to home buyers. Um, I don't know how that helps affordability because that creates demand, which we just talked about, increases values. But what would be good if she could figure it out through those tax incentives, she's committed to delivering 3 million houses in the next, I think, 4 years. Yeah, I had this. I don't know how you do that, but let's pretend for a minute that this is actually possible. Does that concern you? You think it's going to crash the housing market because we have a flood of inventory?
How would that? Let's hypothetically let's say that, and I didn't even know that part of it because like I've been on the road
Yeah, yeah,
traveling, so I've been listening to podcasts and
yeah.
and staying away from politics and everything. So I didn't even know. And just realized last night that the convention was going on.
Yeah, okay.
'Cause I knew it was coming up, but I was thinking it was last week, and it just 'cause I've been on the road for almost 2 weeks.
Yeah.
And just cruising around and listening to podcasts and talking to people, and it's not paying attention to any of that stuff. So I didn't know that part of it. I did hear about the 25,000
Okay.
that she was buying them, but I didn't hear about the wanting the 3 million. But let's just say hypothetically, 3 million over the next what'd you say?
4 years.
4 years. That still doesn't even get to our current needs.
Right.
So would it help the market? Sure, but it's not gonna cause a crash. It might help the market, but how's she gonna do it?
Well, that's what she can't describe.
Because
I don't know where the $25,000 free money is going to come from.
oh, I do. You and me,
Well, the 10 they're going to issue more 10-year treasuries.
which comes from if they do that, that comes from everybody.
Well, because you pay for that in tax called inflation.
And if they give the $25,000 tax, no, they're not. This is not going to happen. People, don't worry. About
Yeah,
it.
yeah, yeah. Let's
This is not. This is just political theater right now, just to buy the votes. That's buying the votes. It's not going to actually happen. Um, it would be nice if they come up with some tax advantages for people to buy. That'll spur the builders to start building more.
Yeah, the tax advantage is for the builders. So they want to incent developers because this is actually good.
Yeah, that would be good, but that's not going to help our problem. Our problem is our population is still growing.
I think it would be great if we could figure out how to get 3 million. I do not think it's going to crash the economy, but it's not going to crash home values.
But I think we still get the 3 million even if they didn't have the tax advantages, because the need is there for it. The demand's there.
Yeah, here's the problem. And this is across the board. It's too expensive to build. I just listened to a podcast today, Mike, that
Is it really too expensive?
I just listened to a podcast today that 30-ish, 33%, something like that. This is a macro view, but about 1/3 of the price to build is dealing with regulation.
Mm-hmm.
Okay, so that's what's making the cost to build.
This gets my point. Is it really that expensive to
I
build?
mean, not in Texas because they just let everybody build, and they.
Right. There's a lot of places you don't have to deal with those regulations.
That's right.
Right. It's a lot cheaper to build in some of those other areas.
And that's why.
And those are the areas
thriving economies.
and those are also the areas that you're hearing the people saying that there's a crash coming, because the builders have been building there because it was cheaper. But what I've been seeing is, and I'm talking to people all over, is like, well, I'm moving there. Well, because the inventory is there and I can buy a house cheaper there.
Yeah.
And so many people right now are remote working or have the ability to remote work. And a lot of people have become self-employed because of the last several years that they are able to work. And I was just talking to a couple people the other night that one's a traveling nurse and she pretty much going anywhere she wants, and she's just picking the locations she wants to work. And there's such a demand for her services that she can go anywhere she wants pretty much. Then I was talking to another guy he's in dance. right? And he's traveling around, going to all the ordways and all that stuff. And he was, because we're out here in Colorado, and he's like, I'd love it out here. He said, I'd love to be able to buy out here. And he's like, I'm like, well, why don't you do it then? He's like, well, I can afford it, but my work takes me everywhere. And I'm like, so what do you do? And that's when he told me about being a dancer. I'm like, so you love dancing? And I'm talking to the guy, and I can tell he's a really outgoing, outspoken person. He's friendly with people. I'm like, have you ever thought about teaching? He says, yeah, I'd love to do that. His eyes just got really wide. He got really excited about it. I'm like, well, I know I hear people all the time who teach dancing. I got a couple friends back in Minnesota that they teach dancing, and people pay for the stuff.
Yeah.
And if you're really that good that you're getting, going to the Ordways and all these, fancy places, you could do that. And he says, then you could afford to live here. And he's like, oh my God, I could do that. And so while we're talking about that, there was another person that was sitting next to us and eavesdropping. It's like, well, you know what? If you did that, and if you were traveling, I would rent your place where you're gone. It's like, so all these different ideas are coming
Yeah,
out.
that's cool.
So this is where I'm seeing more and more people can move to different locations. I see people are moving to where it's a little bit more affordable. And I think you will see more of that over the years.
Yeah. I guess the bottom line for this concern that I've been hearing, first of all, we don't think it's going to happen. I don't know how you do that, nor does she. And even if it did, it would actually be a good thing. I don't think it would hurt.
No, the tax advantages, yes. The $25,000. That
I
would.
know that I'm talking about just having 3 million. I don't think people care so much about the rest of her plan. It's just the delivering of 3 million homes that it has been a concern for some investors.
Yeah, but that's going to happen anyways.
Yeah.
And that wouldn't even be enough to keep up with the demand that.
Well, I hope she doesn't incent builders to do that because it's needed.
Oh yeah, and I think no matter who ends up getting in office, something like that's going to come
I think
because this is a big enough issue for everybody.
I think so too.
And that goes across all political divides.
I think that's something that they probably would agree on.
Yeah.
They just wouldn't tell us that. But they both think that increasing inventory is a positive thing.
Well, and there's nobody could say that's not a positive thing.
Well, I mean, so you're staying in Lakewood while you're out here.
Mm-hmm.
I live in Lakewood. I know this is a Minnesota,
Yep.
But in Lakewood, Colorado, they have growth restriction. They do this in a couple of different towns and cities in Colorado. So not everybody thinks inventory is a good thing. They're limiting it in certain cities.
Well, yeah, but you're just in the small little city. But
Yeah,
you can
yeah,
get
I mean,
out
it's a
around
pretty-
the city. We're talking about the whole entire region. The entire area.
Yes. Yeah.
Now you have some geographical boundaries that you have to contend with.
Yeah.
Right. So you can't just keep building up into the mountains. It just becomes more and more prohibitive, and you can't do mass density up in the mountains areas.
Right.
But you can still the Colorado, Denver area can still grow and expand.
Oh, yeah, there it is.
Right. And there's a lot of places that can continue to grow and expand. I don't know if you've ever driven across Texas.
I have.
You're going to be driving for a long time without seeing anything.
Yep.
You can drive. Actually, you can drive
There's big
a
chunks of
lot
Minnesota like that too.
in Minnesota, in Colorado.
Yeah.
I was up in Utah,
Everywhere.
and everywhere. There's a lot of land to be developed yet.
Yeah.
Right. So the problem is people want to be closer to the inner cities. Right. That's where the issue becomes. And then with the regulations, the more expensive it is. Well, with the ease of communication and traveling these days, people, I think, will, if it gets to that point, people will migrate to where it's cheaper to build and live, because that's always happened. I mean, sometimes you're going around, you're like, why would anybody have ever established a city out here? Well, because
At one time
it was cheap. And then they brought the roads, and then they brought the transportation, and now it's a beautiful place.
Yeah.
And you want to be there. But when it first started happening, only the crazy people would go out there.
Exactly. There's no grocery store.
Yeah, well, we have no shortage of crazy people right now.
That's true. All right, so we got to wrap up here, Mike. Let's close by this. Tell us about Minria in case this is someone's first time, and how do we get a hold of you?
Yeah, so Minria.com, MNREIA.com. And Google us. We meet the first Tuesday of every single month, and we cover all various different topics at our main monthly meeting. But then we have a lot of specialized subgroups to cover a lot of different topics. Like we have an apartment and commercial subgroup. We have a note lab for people who want to learn how to get into financing and sell properties with notes or buy and sell notes. We have a landlord group, and we have a rehabbing group. We have all kinds of different topics. So we pretty much cover everything, but we're on the residential side, not the commercial. We don't have the commercial. We just have that one apartment group for people who are residential people want to get into that. But we do provide a lot of network, and that's the biggest thing that we provide is to connect investors with the people that you need to help you with your business. Whether it's like you with Pine Financial, where people come into the business, they need hard money lenders. Well, they don't know where to get them in the first place until they come to somewhere like Minneapolis or some other group that's already got a connection with you. Yeah, is to just go out and find that, or even to understand what hard money is. Most people, if your brand's making new, you don't even understand what hard money is.
Right.
And then another, like talking about hard money, I tell people all the time, the best education you're going to get as a rehabber when you're first starting out, even if you have the money, you're coming into this business like with a retirement fund or an inheritance, or you've got the money from whatever reason, and you just come into real estate, go to Pine Financial, go to a hard money lender. I don't care where you're at. Use the hard money lender first, and then oh my God, it's so expensive. And no, it's the cheapest education you're going to get, because you're gonna if they turn you down on the loan, there's a reason you turned it down.
Yeah,
and it's because something is wrong with your numbers. So that's going to be an indicator. Because I've seen so many times people oh, I got turned down by this hard money lender or this private lender, and they turned me down. So I just went and did the deal on my own, and they come to me 6 months or a year later. I was like, well, how do I fix this problem?
Yeah.
I'm like, you should have.
I get it all the time.
Listened to us in the first place, because just because you have money doesn't mean you're right.
Yeah, and in a group like Minria, that should be in part of an association like that should prevent a lot of those mistakes, because you are talking to other investors.
Yes.
Now you attract a lot of newer folks. It's really kind of geared for that, but you have a lot of experience in that room.
Oh
too.
yeah, a lot.
Yeah. So I mean, it's a very, very good room to be in, and I don't think you could be successful in this business without a community around you.
Not to be successful in a timely manner. You can do it slow. You can do it like I did, real slow and steady over years. And and then I was traveling all over the country, and I talk to people like, well, you need to go back to your RIA. I'm like, what's that? I didn't know what it was. And then once I started meeting and networking with other investors, that's where my investing career exploded.
Yeah.
So I was 15 years of me being in real estate before about 12 years before I really started taking off. Because I was doing it slow. It was a slow grind, because I thought I knew everything there was to know about real estate investing until I started talking to other people.
Yeah, I went to RIA first before I bought my first one.
Yeah, I didn't even know about a RIA until I probably bought 20.
Yeah.
And then I couldn't even find one because we didn't have one in Minnesota.
So you created it.
Yeah, I didn't create it on purpose though. I just started networking with other people, and then we started talking to other people, and it just kind of grew from there.
Well, it's a fantastic group. Sean from Pine is out there every single month, I think. He's a fantastic resource. You're obviously there. I mean, except for the last time I was there, you weren't there. But for the most part, you're there every month.
Yep.
So minria.com, you said?
Yes.
Minria.com. We'll put it up in the show notes. Any final words of wisdom, anything you want to share before we get together in 3 months' time?
Just don't be afraid of the market. Just know what the market is. Keep an eye on what's going on out there, and just get out there and find deals. Even if you don't know how to put the deal down, go find the deal. Because what we're looking for is motivated sellers. So I need people like you who are, you're just out there, even if you're just learning and you're afraid of the market, just get out there and find deals and bring them to people like me. Or if you're out here in Colorado, check with Kevin. I'm sure you got plenty of investors out here that you can work with as well. Because I'm looking for deals. So I will pay. I buy from wholesalers. So that's just get out there and do it, and learn how to do it right. But if you make a mistake, learn how to wholesale and the right way to wholesale. Because this is one of the things too I teach back in home. This is another one of the big groups I teach wholesaling. But one of the things I teach people is the only way you're going to get out here and be successful is just get out there and do it. Yeah. And I've learned over the years most people are afraid to just get out there and do it because they're afraid that if they do it, they're going to make a mistake and lose money or ruin their credit because they can't pay a loan back or whatever. Yeah. Don't be afraid to do it as long as you're doing it right. And if you make a mistake, I teach people how to get out of the contracts.
Yeah.
Right. Not that I want you to get a property under contract and then walk away from it, but I want you to get out there and make the offers and then bring it to me or somebody like me or somebody. And then if you can't find the end buyer because the numbers didn't make any sense, we can teach you why the numbers don't make any sense. And then you can either tweak the numbers with the seller or you can get out of the deal without losing any money or risking anything.
Yeah, it's totally risk free.
That's one of the best ways to get started in real estate if you're afraid to get out there and just do it and don't have the background and don't have the support already. And come to the RIAs because that's where you're going to get your support. We are each other's support group.
Yeah. I never asked you this. Do you ever partner?
Yeah.
Like, would you like mentor someone through a deal if they brought it to you?
I do, yes.
Yeah. Okay.
Yeah.
That's cool.
So I either buy it from people or I partner up with them and let them do it and I coach them through it.
Yeah. So my guess is what I've seen with those is if you bring a deal to Mike and you have to line up the money, so
Yeah.
we can help you with that. But if you have the deal, then maybe that's a good way. So you don't. I mean, that's really getting an education if you go through the deal and do the work.
Right. That's the best way to do it.
Yeah. All right, cool. Well, Minria.com, you can check us out, pinefinancialgroup.com. And again, the special report, if you want that for free, we're comparing the the crash that happened in 1990 to what's going on right now. You can get that at www.thepinereport.com. So thank you, Mike, for flying all the way out here. You didn't fly, you rode your motorcycle, but thank you for coming all the way out here and spending this hour, a little over an hour with me and our listeners. And to the listener, thank you so much for giving us your time. There's lots of things you could be doing. You chose to hang out with us. Really appreciate it. And I hope you make this day a great one.